All right, guys, welcome to 2026, the greatest trading year of your life. I know it for a fact. I can feel it in my bones, especially if you're following this page. I'm going to be releasing a lot of valuable trading content for completely free this year. So make sure you're subscribed, follow along. And right here, I'm going to be showing you the best strategy in 2026 to become profitable. Okay, so before we jump into the strategy, I just want to run through the main reasons why most traders never become profitable. After mentoring students for years, these are the 4 core reasons most traders fail. So the first one is trying to trade every single day. I put this at the top of the list because I see this by far the most. As day traders, we need to align ourselves with the higher time frame, with the daily time frame. We're intraday traders. We want to trade the momentum of that daily candle. And so not every single day makes sense. There's no clear trade every single day. And so what a lot of traders do is they make $1,000 one day, they go into the next day going, oh, I can make another $1,000. They don't even look at the higher time frame. They're not looking at the daily chart. The daily chart is just chopping, and they enter a trade. They lose all the profit that they made the day before. And at the end of the week, their P&L is just either up and down, or they lose money for the week. But if they just took those clear days, they just traded on the days that were clear and obvious, they'd be up on the week. And so we only want to trade when the daily chart makes sense to us. The second one is trading against your bias. I cannot stress this enough. It is so important to have a bias. The industry at the moment is trying to remove bias. It's saying if you see a 15-minute breakout, just drop down to the 1-minute time frame, take the trade. It doesn't matter about the higher time frame. It doesn't matter about a daily bias. It is the most important thing in your trading. The reason they're doing this is because you blow more accounts. They want that. They also want you to make more trades, which you will if you're not using a bias, which means they get more commission fees. And that's exactly what they want. You need to trade alongside your bias. And we'll get into that further in the strategy. So the third one is having no risk management whatsoever. The main reason most traders ignore this is because they think it's too difficult. They think it's complex. They've got to do all these calculations. You do not need to overcomplicate risk management. It's really simple. It's how you manage yourself in the trade and when you get out of the trade. So what I do is if I have a win for the day, I stop trading. Unless there's an A+ setup that shows up, I walk away from the computer, I take my win, and I'm done for the day. If I lose a trade, I get one more trade at half risk. Whether I win or lose that second trade, I am done for the day no matter what. And that is risk management for me. It's simple, it's easy to follow, and that is how I manage my risk. And the last one is emotionally trading. Most people won't care about this one, but it's probably the most important on this list. The majority of people watching this video are purely emotionally trading. How do I know that? Because I was doing it for such a long period of time and I had no idea whatsoever. It wasn't until I started journaling every single trade that I took, how I felt before, during, and after every single trade. I realized I was purely emotionally trading. I would get angry at one trade, so I'd overtrade. I'd get annoyed that I lost a trade, so I'd FOMO into another trade. Everything I did was purely based off emotions. I had rent due one week, so I'd force a trade. I had to pay for this thing coming up, so I'd force another trade. Everything was emotional. And that's what the majority of people do in trading. They're not trading a strategy. They're not trading a system. They're trading purely based off their emotions. And so you need to journal every single trade you take, not just what happened in the trade, but how you felt before, during, and after. It is so important. It'll change the way you trade. Okay, so the very first part of this strategy is daily bias. Like I said at the start of the video, daily bias is the most important thing. There's 2 questions that I ask myself at the start of every single trading day that helps me identify my daily bias. The first one is, how did we react off the previous daily low or high? The second one is, how do we react off daily points of interest? Now let's get into exactly what I mean by these. Okay, so before we can dive deep into daily bias, you need to understand these 2 main concepts. So the first one is open high low close and open low high close, and the other one is IRL to ERL, which is just internal range liquidity to external range liquidity. Every single candle, it doesn't matter what time frame, either has an open high low close or an open low high close. This is super simple. There's no need to overcomplicate it. It just helps us understand how the daily candle is going to move. So in the bearish situation, we have an open high low close. So we open up for the day, we move higher to set in the high, we expand lower to set in the low, then we close out for a bearish daily candle. Then we have an open low high close. And so we open up for the day, we move lower, set in the low, move higher, set in the high, and then we close out for a bullish candle daily closure. Okay, so to keep things super simple, we're going to run through a bullish daily candle, which would be an open, low, high close. So we open up for the day, we move lower, set in the low, move higher, set in the high, and then we close out for the day. What would that look like on the lower time frame? We would open up for our Asian session, normally accumulate, trading sideways, move lower to set in the low of the day, sweeping out liquidity below that Asian session low. This allows institutions to enter at traps, a lot of traders offside, thinking the market's going to continue moving lower. Then we break to the upside, moving to set in the high of the day, and then we close out for the day, and that would be our bullish daily candle closure. Okay, so now we're going to run through a bearish daily candle, which is an open high-low close. So we open up for the day, we move higher, set in the high, move lower, set in the low, and then we close out for a bearish daily candle closure. What would that look like on the lower time frame? The Asian session would open, we normally accumulate sideways, we then move higher to set in the high of the day. What does that do? We manipulate the liquidity resting above these highs. We trap traders long, thinking the market's going to continue to expand. That allows institutions to enter the market and distribute in the opposite direction, moving all the way down to set in the low of the day, then moving up to close out for the day. And that is a bearish daily candle on the lower time frame. This right here is what we call AMD, accumulation, manipulation, and distribution. Accumulation is just a generation of orders. We're engineering liquidity in the marketplace. Manipulation takes out all that liquidity, allowing institutions to enter the market and move price in the direction that they want, and that is the distribution phase. We want to trade the distribution. Okay, so now we're back here. We're going to run through internal range liquidity and external range liquidity. The marketplace at all times is just seeking liquidity. That is all it is doing day in, day out, is seeking liquidity. We want to identify what liquidity that the market is seeking, and we trade towards that liquidity. Okay, so before we move on to that, I'm just going to give a really simple breakdown of what liquidity actually is. It's the most important thing you can understand as a trader. It is how the markets move. It is the foundation of why all markets move. If you can understand liquidity, you can trade any market you like. It is simply just orders resting in the marketplace. And all it does is seek and destroy those orders at all times. And so if you're a buyer, you need a seller. If you're a seller, you need a buyer. So all the market's doing is moving from one area of liquidity to another area of liquidity. Okay, so obviously institutions need liquidity to enter and exit large positions. Price moves towards liquidity, not away from it. Stops and orders create liquidity. So all we want to do is identify an obvious area of liquidity and trade to that area of liquidity. So the first one is internal range liquidity. When we have a massive move in the market, let's say we move down heavily, it leaves behind orders resting in this move. And so what price does is it wants to rebalance this range, moving back up to grab orders, grabbing liquidity before continuing this move to the downside. And this would then create what's called a downtrend. And so we move down heavily, we move up to grab orders, grab liquidity so we can continue moving down, because no one wants to sell here. We're so far down. We wait for price to want to move up, grab orders, grab liquidity, and then we continue the move to the downside. The exact same thing happens when price is moving higher in an uptrend. We have a move to the upside. Price comes back down to rebalance this leg, coming down into internal range liquidity, picking up orders, picking up liquidity before continuing this trend to the upside. Price comes back down into internal range liquidity, rebalancing this leg, picking up orders, picking up liquidity, and then continuing the uptrend. So instead of calling this higher highs and higher lows, higher highs and higher lows, we understand what's actually happening here. No one wants to go long here. So the market moves down, seeks liquidity, picks up orders before continuing moving higher. No one wants to go long here. We're way too overextended. The market moves back down to pick up orders, pick up liquidity before continuing to the upside. Internal range liquidity. When we have a move to the upside or when we have a move to the downside, we create imbalances in the market, and that is our internal range liquidity. Price likes to rebalance that range, coming down into internal range before moving to external range, and we'll go over the external range now. Okay, so now we have external range liquidity. It's super simple. It's just highs and lows resting in the market, external range liquidity. So here we can see prices move to the upside, setting this high. Then it's moved back down into internal range liquidity, finding liquidity resting internally in this leg here, rebalancing this range. And now we're starting to move back to the upside. Where do you think it's heading towards? External range liquidity. And the reason that's important, the reason there's liquidity there is because people would have gone short here and they have stop losses resting above this high. And that is liquidity resting in the market. That's orders resting in the market. And what does the market want to do? Seek and destroy those orders. So the price is normally always going from internal to external, seeking liquidity. Here you can see prices move down aggressively, set in this low. Prices move back up into internal range liquidity, rebalancing this leg here, finding liquidity internally in that leg, and then it's starting to move back down. Where do you think it's heading towards? External range liquidity, because there's probably stop losses here from people that went long chasing this move to the upside. And that is how the market moves. All right, so here we have two examples on the daily time frame, which means every single candle here is a daily candle. The example on the left here, you can see price moves down aggressively. We set in an external range liquidity low. The next day opens up, we come down below that external range liquidity, filling all the orders, taking the liquidity, and then we form a reversal candle to the upside. We've taken out external range liquidity, so now where are we going to head? Back into internal range liquidity. So the way that we identify internal range liquidity is using imbalances and gaps in the market. If you don't know what imbalances are, you can just Google it. You'll find a lot of videos online. But basically what it means is when price expands heavily in one direction, it leaves behind gaps and imbalances in the market. It's a 3-candle pattern where the first candle does not touch the third candle. And so the wick here and the wick there, there's a gap in between here. That is our imbalance. And we identify this as our internal range liquidity. Okay, so now we can clearly see what's happening here. We've taken out external range liquidity, we've flipped green on the day, and we have internal range liquidity resting right above. So going into the next trading day, what are we expecting? We're expecting a bullish candle heading towards our internal range liquidity. So now we can pair this with our open, low, high, close, expecting the next day open up, move lower, set in the low of day, before expanding higher to our internal range liquidity, and then closing out for the day. And that would be a bullish daily candle closure. Okay, so moving on to the example on the right here, we can see price action has taken out that previous daily high or that external range liquidity high, and it's moved back down into internal range liquidity, rejecting out of that area. So we've gone from external to internal, and now we expect price to want to gravitate back to external range liquidity, but it's no longer here. It is now here, that previous daily high. That's now our draw on liquidity. So going into the next trading day, what is our bias? We're expecting price to want to draw higher. So we're bullish on the day. This is how we use these tools to come up with our daily bias. So what are we expecting? We're expecting an open, low, high, close. We expect the day to open up, move lower. This is where we look to get long, to target our draw on liquidity, which is that external range liquidity, that previous daily high. So open up, move lower, expand higher, set in a high for the day, and then close out for the day for a bullish daily candle closure. Okay, so again, to keep this super simple, all we're asking ourselves on the daily time frame, is price moving to external range liquidity, so highs or lows resting in the market, or is it moving to internal range liquidity, which is imbalances resting in the market? And then we can use open high low close or open low high close to give ourselves a bias for that next trading day, what we can expect to happen. So if we're bullish, we wait for the day to set in a low, and then we can trade the distribution of that daily candle, expecting price to continue moving higher. Or if we're bearish, we wait for the high to get set in, and then we can ride the distribution to the downside. And we don't have to catch the full move. We just need to take a small piece of that daily candle. We're going to run through exactly how to do that. Okay, so now we're going to talk about previous day high and low and why it is so important for our daily bias. We're on the daily time frame here. In this bullish example, you can see this daily candle has closed above the previous daily candle's high. Whenever we see this in the market, we can expect price on the next day to want to continue moving to the upside. This is a bullish signal for bullish momentum in the market. And so we make the previous daily high the new draw on liquidity. Why is that? Because we can expect stop losses, limit orders, liquidity to be resting above this high. And so going into this new day, we're expecting price to want to draw up to that level because institutions want to get their orders filled where all the liquidity is resting. And so what does that mean? We are bullish on this new day. And so we're expecting an open, low, high, and close. So we expect this candle to open up, move lower. This is where we look to get long. We look to get long as this day is moving to the downside. When we set in the low, we expect price to want to flip around and the daily candle to head towards that new draw on liquidity, which is that previous daily high. And it's the exact same when price is moving to the downside. Here we can see this daily candle is closed below the previous daily low. And so going into the next day, we're expecting price to want to continue moving to the downside. So we set the previous daily low as the new draw on liquidity because that's where all the orders, all the liquidity is resting. So we expect institutions to want to drive the price down there so they can fill their orders. So we wait for this day to do an open, high, low, and close. So we expect price to want to move up first, setting in the high of the day. This is where we look to get short, to continue this move down to our new draw on liquidity, which is that previous daily low, and then the day closes out. Okay, so now let's say the day is finished. We reached our target on both examples, as you can see. So we reached up above that previous daily high, and then we reached down below that previous daily low. But here you can see once we took out the liquidity resting above that previous daily high, we moved back down inside of the range, which means a lot of selling pressure kicked in. We didn't close above that previous daily high, we closed below it. So what does that mean? Going into the next day, I'm expecting price to want to continue moving to the downside. So where is my new draw on liquidity? The previous daily low. So I expect an open, high, low, and close. I expect price to want to move up first, set in some sort of high, and then move down to our new draw on liquidity and close out for the day. The exact same thing on the bearish side. You can see we reached our draw on liquidity, which was that previous daily low, sweeping out all the orders resting below here, and we've closed back inside of the range. We did not close beyond the previous daily low. If we did, I would expect price to want to continue moving down, but we closed back inside of the range. That tells me that a lot of buyers have stepped in after taking out this liquidity, meaning price is likely to move to the upside. Where's our new draw on liquidity? The previous daily high. So what are we expecting for that next daily candle? An open, low, high, and close. So the candle will move lower, set in some sort of low. This is where we look to get long before riding the distribution of this daily candle to the upside and then closing out for the day. Okay, so what else can we see here? We can see we've taken out external range liquidity, this previous daily high, and now we expect price to want to move into internal range liquidity. How do we identify that? We look for imbalances in the market. There's a gap between this candle's low and this candle's high. That's our imbalance. That's where our internal range liquidity is. So we expect the next daily candle open up, move higher, draw lower to that previous daily low, which is our draw on liquidity, to our internal range liquidity. The same thing on the bearish side. We've taken out external range liquidity here, and now we expect price to want to draw back into internal range liquidity. So we look for our imbalances. This candle's low, this candle's high. That's our imbalance. We expect price to want to draw back into that internal range liquidity right near that previous daily high. Okay, so now I'm going to show you exactly what to look for when executing this strategy. One of the most important things is when you are trading. You want to trade in these time windows because that's when volume and volatility steps into the market. If you trade outside of these windows, the trade probably won't play out. All right, so we're on the daily chart of the NASDAQ, and here's an example of how powerful a daily bias can be. So here we can see we've taken out this previous daily high, this external range liquidity high, sweeping out the orders resting above here, but we've closed back down inside of the range. What's that telling us? Sellers stepped in, it stopped price from going any higher, and so now we've taken out external range liquidity. We expect price to want to move down into internal range liquidity. And so we look for an imbalance in the market, which we can see from this candle's low to this candle's high. And so what do we expect going into the next day? Price to move down into that internal range liquidity. So our bias for the next day is bearish. We expect an open, high, low, and close. Let's see what happens. Price moves down and fills that imbalance completely, and we have a lot of buying pressure with this rejection week back to the upside. So what's that telling me? We've gone from external range to internal. We had all this buying pressure here. So what do we expect now? Back to external. Where's the first draw on liquidity? The previous daily high. But we also have this external range liquidity high up top here. So let's see what the next day does. We push through both of those draws on liquidity, and now we've closed well above the previous daily high. So where's our new draw on liquidity? The previous daily high, which is right here. So let's see what the next candle does. We blow straight through that. And so now we've closed above the previous daily candle high. Where's the next draw on liquidity? Previous daily candle high. Let's see what happens. We blow completely through that as well. So where's the next draw on liquidity? The previous daily high. We take out that draw on liquidity, that previous daily high, and we close all the way back down inside the range. Let's get everything off the chart so we can clearly see what happened. We took out the previous daily high, that external range liquidity high, and then we've closed all the way back down inside the range. So we've gone from external. Now we expect price to want to draw down into internal range liquidity. If we look internally in this range, can we see an imbalance? Yes, we have an imbalance from this low to this high. That is the gap in the market we expect price to want to draw down into. So what's our bias going into the next trading day? We are bearish. We're expecting an open, high, low, and close. And where's our next draw on liquidity? It is the previous daily low. So let's see what the next day does. We draw all the way down to that internal range liquidity, that imbalance in the market, but we close beyond the previous daily low. So what's that mean? Our new draw on liquidity is still the previous daily low. So let's see what the next candle does. We draw all the way down, filling that imbalance completely, but we close above the previous daily low. So now let's get rid of all of this. We've gone from external down into internal. Now where do we expect price to go? External range liquidity, okay? So let's see what price does. We move all the way back to external range liquidity, okay? External, internal, external, internal, external, internal. That is how the market moves day in, day out. Okay, so now I'm going to show you an example of how this model works from start to finish. Before we do that, I need you to get this indicator. It's completely free and has nothing to do with me. So go to indicators, type in ICT kill zones, and there'll be one from Trade for Op, ICT kill zones plus pivot. So add that to your chart. And these are the settings that I need you to add. So just copy this completely, okay? And so these are all the timings, the kill zones, which are the timings for when we make trades, okay? Which I showed you earlier. And so you want to copy this completely. And what you also want to add is the true day open, okay? So add all of this to your chart and then we'll get into the example. Okay, so we're on the daily chart of the NASDAQ again. And here we can see we have closed well beyond the previous daily high. And so what's our new draw on liquidity? It is the previous daily high, okay? So now we have a draw on liquidity. So we go DOL, that's our draw on liquidity. Now we drop down to the 15-minute time frame, okay? And you guys will now see that indicator that we just turned on. So we can see that New York AM session high, that's that previous daily high. That's our target for this day. Our bias for the day is bullish. We're expecting price to reach that previous daily high. So now we want to see price come down to a certain area where we can look to enter and target that previous daily high. Okay, so now you have that indicator on your chart. You can clearly see all the time windows that we spoke about earlier. You only want to trade inside those time windows. It's super important. And so here we can see the whole previous day. We can see the Asian session, London, New York AM, New York PM, and now going into the next day, just like we saw on the daily chart, our bias is bullish because we expect price to want to draw up to that previous daily high. So our bias is bullish, which means we're expecting an open, low, high, and close, okay? And so where are we expecting price to want to move down to before we continue higher? That's a very important thing. We'll go through that now. So go back into your indicator settings, double tap up the top here, scroll all the way down until you get to opening prices. You need to add true day open. It's midnight New York time. Make sure you have this on your chart. It's so important. So here's a really quick rundown on how we use our true day open. Like I said, it's midnight New York time. The indicator will automatically draw this out for you. Let's say our bias on the day is bullish. We're expecting the daily candle to do an open, low, high, close. So we're looking for longs. The best longs, the best buys are below the true day open, okay? On the short side, let's say we're looking to sell the market. We're bearish on the day. We're expecting an open, high, low close for our daily candle. The best sells, the best shorts are always above the true day open. It's that simple. It just adds a confluence to your trade. Okay, so now we're back at the example on the 15-minute time frame. We can see the whole previous day using these time windows, starting from the Asian session. On the daily chart before, we identified that going into this day, our bias is bullish. We're expecting the daily candle to do an open, low, high close, expanding towards the previous daily high as our draw on liquidity. What does that mean? That means we are only looking for longs. We're only looking for buys below the true day open. We're about to have a new day open here. We're about to start the Asian range. So let's see what happens. Price opens up, the Asian session starts, we get our true day open. The indicator automatically prints the exact price at midnight New York time. You can see we dip below the true day open here. Why don't we enter here? Why is this not a valid setup? Because it's outside of our timing windows. And now we have the London session open. We dip down below again. We have a V-shaped recovery. This is where we enter. We would enter long here, putting our stop below the London session low and targeting our draw on liquidity, which is that previous daily high. And here you can see price, it'll just run straight to our target. Okay, so now let's see what happened here. We had a perfect AMD. Our Asian session just accumulated. During London, we manipulated below the true day open, below the Asian session low, sweeping liquidity and orders. This is the perfect spot for us to enter long so we can ride the distribution to our draw on liquidity, which is that previous daily high. This is exactly what we want to see. Like I said, this is not a strategy. This is how the market moves from one area of liquidity to another. In the very next video, I'm going to show you every single entry model that I have that allows me to catch these massive moves in the market. If you want to learn my full strategy, you can see it in the description below. Otherwise, like, comment, and subscribe, and let's have the best trading year of our lives. All right, guys, peace.